into it. We're going to record this. So, guys, we're going to go over almost like back to basics, but we're going to go. Hopefully, there'll be some light bulb moments about really simplifying the way we're going to look for trades and things like that. So, very quickly, we obviously know what the 4 different types of movements are: your expansion, your retracement, your reversal, your consolidation. But what we need to really get good at is defining the reference points in institutional order flow. So we need to start thinking about order blocks, which is on, yes, everyone should be on mute, I think, at the moment. Order blocks, imbalance, liquidity grabs and pulls, and equilibrium as well. Let me just mute everyone. Is that better? You should still be able to hear me. Cool. So what we know about what price does, we know that price moves in cycles. And this is when we want to be buying when it's low, just here. We want to be selling when it's high. So if I change that color really quickly. So we want to be selling at highs. Now, when you go deeper into it, what you'll find is areas where you can identify the trading range. So if price is expanded to the upside, we then need to look to identify our trading range. Now, we can work with the 50%, we can get the 70, the 88%, things like that. But for now, let's just focus on getting our discount area. And within our discount area is where we are looking for order blocks, imbalance, liquidity grabs, liquidity pulls, and we do that on a smaller time frame. This here is going to save you loads and loads of stop losses, because the amount of times educators out there, people have taught you or taught people to use the last up candle, last down candle before the up move, set the order on a higher time frame, which, don't get me wrong, sometimes comes in really, really well. But how can we stop ourselves from being stopped out? So the simple answer is we wait for evidence. So when we're waiting for evidence, we're on a smaller time frame, waiting for price to give us a reason to push higher, just like that. So we can see here, we're in a retracement phase, and we're reversing to the upside. We're breaking structure, and we need to come back down to this area to mitigate. This is your accumulation from a higher time frame perspective, because we're already bullish and we've accumulated within our point of interest. So let's just say this is your daily time frame. Let's change the color of this one and call this maybe the 1 hour time frame. And you can be, they can change, so it's not to, it's subjective. And then what we're going to then do is look for areas to move inside of our new trading range on a smaller time frame. So we can wait for price on maybe a 5 minute, a 1 minute time frame to then break structure again, giving us reaccumulation to the upside. So this here is your reaccumulation on, let's call it a 5 or 15 minute time frame. So 5, 15 minute time frame. So it's always best to wait for the reaccumulation within your areas of interest, because that way we are getting extra evidence, and also you can get really, really good risk reward trades compared to if you set your entry down here and you eventually, got up here, you may get a bigger risk reward ratio on a smaller time frame. So also what this helps with is prevents you from being stopped out, because in a situation where price is going to reverse on the higher time frames, all we're going to do is see this. So we're not going to be intending to get in. But what happens when we get in here and we've swept under this low here? what we can then do is anticipate moves to the upside for a long-term sell. So, for example, if I just make that bigger there. On a smaller time frame, when price is bearish and it breaks below the low that exists over here, you can anticipate price needing to, at some point, accumulate to push higher. So we can eventually get ourselves in short-term areas. So if you go back to sort of like maybe the daily, the 1 hour, imagine it being a big candle. So this here is your move. And then we're waiting for price to get there because we're going to change our bias. So this on the daily is our sell area now, but we can buy into the area because we've closed below. So we can still potentially look for buys, just not in our point of interest. And it has to be when we get accumulation to the upside. And the best place to get it is after a consolidation phase. So if we've consolidated for a while and we've closed low and then closed high, then obviously you guys know this pattern. We look like we know we can get in on this area here to the upside. So looking at what the charts present with us here, I mean, this is GU. Let's go on this one because there was a trade here. Right here, we can see the expansion to the upside. This here is a perfect example of the accumulation phase happening right here. This is on a 15-minute time frame, and that is after taking out all of this trend line here, taking out all of this liquidity in here. We can see the trend moving down, moving down, moving down, moving down, price pushing up, coming down. Now, what you then have to do is identify your trading range. We know we're inside our discount level. Within the discount level, what can we find that is of interest to us? Well, we can find this FU candle. An FU candle is a candle which swept liquidity. An institutional candle is the same, but it just didn't sweep the liquidity. So we haven't got any imbalance. So that possibly is a red flag because it's always nice to have imbalance. But what we have got is this big expansion to the upside. So that's really showing us that price is going to push higher. Really convincing move. And then what happened is price slowly made its way into this area here. So that there is a nice entry and it got you out. That's the high. So you're already in profit there. But if we go one level further, we can anticipate what price may be doing next. So we can maybe have a look and see if we can find potential moves to the upside. So now let's just move that to the side. So we know it's there. We can identify structure on this time frame here. Now, this is when you need to start think about price moving in structure here. So if you go onto the line chart, you can see what happened. Price was moving down, price is moving down into where our 1 hour tapped us. So we're in the trade on the 1 hour, the 15-minute, and price breaks structure right here. Now we can have a look at the candles. We can identify the trading range. What's here? This is our zone right here, our discount zone. So we want to get into price here. What can we identify in here? Well, if we refer back, we're looking for order blocks, imbalance, institutional FU candles, liquidity sweeps. Well, we've swept liquidity right here. So that's a no-brainer. We've got this area here. Price taps in perfectly. We've also got imbalance right here. This is just rinse and repeat all day, every single day. And what can we find? Price taps into our entry to the pip. And obviously looking at what your targets are, you could go for, to take this high here. You could aim for this high here. That's a 6-to-1. Now, obviously looking at what price did there, you're realistically probably going to come out of this high here. So that's where it got taken. That high over here was taken. That's an 8-to-1. Compared to your 4 or 5-to-1, you've doubled it on the 1 minute time frame, and you're waiting for the same thing, and you've got evidence that price is moving higher. So it's just a case of waiting for that extra evidence. Now, you would have had a bit of a scare because obviously price came all the way down back into drawdown and pushed higher to the upside. And if you had have held it, which I don't think many of us would, you could have got yourself a 10-to-1. But even just coming to this high here, which is that high right there, we can see that that would have given you an 8-to-1. So you could have come out in profit there. Even if you saw price aggressively moving down, you could have come out maybe a 6-7-to-1, or you would have had your stop loss at break even, whatever. But this here is pitch perfect, what we're looking to do. And you just do this on every single time frame, rinse and repeat. And we can identify that we've had the reaccumulation in our 15-minute area. So you can see now price is moving higher. But how do we get into price if we miss the move? It all depends on our overall targets. So looking at this here, we've identified that, you know, we've made this high, we've come down. This is our first target right here. But price could easily react from this area here and come down. So that's not really a sufficient target. So you could be targeting this imbalance. But at the moment, there isn't really anywhere for it to go. So what you could, when price is lower, so for example, the entries you could have gotten within this area here, if this wasn't here, it's a bit of a shame, because essentially you then look for areas of imbalance to take price all the way up. If you were on the alerts channel earlier, I was looking at the indices in all the different imbalance areas for potential to take price higher and higher and higher. So if we actually go on to the indices, have a little look. So overall, you know, we've obviously taken Monday's high. Looking at what happened from the New York session today, price came into this area here. And this is where you can take short-term scalping opportunities. When, let's say the, you know, for example, the entry is down here, just as an example, it's hypothetical in this situation. Now, this high is the target. What you can end up doing is seeing price expand away from the previous low. So we've got price moving away, we've broken structure, we've come in, we've filled, we've pushed higher. That there is kind of your drawdown area, taking price higher, leaving an area of imbalance right here. So there could have been an entry there, but you can take that because you're here. You're moving in here. But once price takes above it, there's not really a valid entry point anymore. So it's all about targets. Realistically, it's about looking where price should go. So if we move to maybe Dow, and if you've got any questions, guys, please feel free to put them in there. So this was 3 o'clock today, or yesterday. Where are we today? So looking at what price did, Dow, we can see price moved into here, so we can follow price up. Now, why are we in here, buying in here, and not down here? So let's say we missed this move yesterday, because this is a really good buy opportunity right here, New York session yesterday. That there's a really good buy. I don't even need to go onto a lower time frame to see that there is a really, really good opportunity to buy. And I'm sure we would have had price, you know, taken us in. In fact, if we have a little look at what's actually happened in here, we can hopefully get some idea. So price moves in, creates this structure, comes down, fills in this imbalance here within this order block right here. Price moves higher. So you could have got yourself. So there's not really another. Okay, so here it is right here, 5-minute time frame. You can see price has reacted. Price is moving higher. Price has made this low. It's made the short-term high, short-term low, broken structure. So that there is your structure break. Price has come down and taken it in. That there would have been a really nice entry yesterday at around 4:45. Not ideal time, because we don't really want to be trading that much later in the day, but you could have got in on this imbalance. You wouldn't have got the entry unless you tapped in early. But that there is you know, really, really nice entry. But focusing ahead to today, if ever knows, what is the order block? So an order block essentially is an FU candle, an IC candle, and that is an order block. But the reason you can use the word order block is, so for example, this area right here, where there's 2 candles, if you wanted to, you could use both candles as your order block, because 1, 2 is responsible for the move down, which swept below this liquidity and then pressed higher. You get better, more refined entries when you're using the last down candle, but a lot of the time, price can just come to the top of the move, which is this area here. So 1 and 2 candles. So like here, 1, 2, they're ordered. That's an order block. that is also an order block as just one single candle, but the move in general. So even if you just want to forget about the word order block and just think of the move down before the move up. That's kind of how I learned it when I was learning all this sort of stuff. So right here, 1, 2, 3 candles, that there is a sufficient order block. And